It's going to take a while to restore confidence in the financial system.
1 full percentage point cut by the Reserve Bank.
Idiots.
Wall Street's been bailed out, but is it enough?
Right now, we want to put out that 5 aspects.
On March 14, 2008, the United States Federal Reserve faced a problem nobody in the government knew how to solve. Bear Stearns, one of the 5 largest investment banks in America, was hours away from collapse. Its balance sheet was full of what were politely called complex financial instruments, mortgage-backed securities, collateralized debt obligations, derivatives stacked on derivatives. I'm not even going to try to pretend like I understand it, because if Margot Robbie couldn't make me understand, nobody can. But these were financial products which were so layered and so opaque that nobody inside the firm could say with confidence what they actually were worth. The feds, they needed to value those assets accurately, or the bailout, it wouldn't work. And so the Federal Reserve, the central bank of the United States of America, with access to the greatest concentration of economic expertise in the world, they made a call. And they didn't call a government agency or a university or not even another bank. They called a private company in Midtown Manhattan. That company was BlackRock. And the tool to bear on Bear Stearns' $30 billion in toxic assets was a piece of software called Aladdin. That phone call and what came after it is what this video is about. Not because BlackRock is sinister or because the people who built Aladdin had bad intentions. Quite the opposite. But at least relative to the standards of Wall Street. This is a story about how a system that works so well and that so many people have come to depend on, that it has quietly become the most dangerous single point of failure in the history of global finance. And the thing that makes it so dangerous, it's not that it's broken, quite to the contrary, it's because it's right.
I want this done.
To understand Aladdin, you have to go back to 1998. Larry Fink was 35 years old and he had just been pushed out of First Boston after a bad trade that cost the firm $100 million. His firm, his calculation, his career-defining mistake, or so he thought. He started a new company called BlackRock out of a single room in the offices of a private equity firm without any clients, without any assets. It just had 8 people. But what he did have, apart from those 8 people, was a thesis about risk. Fink believed that the financial industry was flying blind, that the instruments being traded, particularly the mortgage-backed securities that were just becoming mainstream in the 1980s, they were far more complicated than anyone was modeling them as, that the risk embedded in these products was real and specific and quite measurable. But that nobody was measuring it properly because nobody had built the tools to do it yet. So, they built the tools. Aladdin, which stands for Asset Liability Debt and Derivative Investment Network. A name so deliberately technical, it almost sounds like it's trying not to be understood, and it was designed as a risk modeling engine. Its job was to look at a portfolio of financial assets and answer a single, simple question. What could go wrong? To do it, it runs on what are called Monte Carlo simulations. You take a portfolio and you run it through thousands of randomly generated future scenarios. Interest rate spikings, markets crashing, currencies collapsing, and you see what the portfolio looks like in each and every single one. Do this enough times, across enough scenarios, and you start to build a statistical picture of where the real risk actually lives. In the 1990s, this was revolutionary. Most firms were estimating risk through gut feel, rules of thumb, and models that treated the future as a simple extension of the recent past. On the other hand, Aladdin treated the future as a distribution of possibilities, which is actually what it is. It tried to see what the other systems weren't seeing, and it worked. BlackRock grew, its clients trusted the analysis. Nobody had a blow up on the scale that Fink's models predicted they should avoid. Then, 2008 happened. and suddenly everyone in the world needed to see exactly what BlackRock saw. The sequence of events in early 2008 is worth understanding specifically because the details matter. In March, the Feds called BlackRock to analyze Bear Stearns' toxic assets. Bear Stearns was acquired by JP Morgan in a deal orchestrated by the Fed. But to structure that deal, someone needed to know what those assets were worth. The government, they didn't have the tools, but BlackRock, they did. Then AIG collapsed in September. BlackRock was called again. AIG's derivative exposure was so tangled that the government needed outside help just to understand what they had even agreed to bail out. Then Citigroup, then the Federal Home Loan Banks, then Fannie Mae, which carried a $5 trillion balance sheet that the government had just taken onto its books, and they again needed to urgently understand what they had just taken on. By the end of 2008, BlackRock had been hired by the Federal Reserve, the US Treasury, and multiple foreign central banks to analyze portfolios totaling trillions of dollars. They received at least $180 million from the Fed for the work. The United States government, during the worst financial crisis since the Great Depression, did not have the internal capacity to value its own emergency assets. And you need to think about what that means. The fact that they had to hire a private company with a proprietary algorithm nobody outside the firm could audit to do it. This seems like a conspiracy, but it wasn't. It was a capability gap that BlackRock had built into an entire business, and that the crisis suddenly made visible. The government needed the tool. BlackRock, they had the tool. The deal made sense in the moment. But something changed after 2008 that's nobody quite planned for, because now suddenly everyone wanted Aladdin. In the years after the financial crisis, there was a widespread and entirely reasonable conclusion drawn by pension funds, insurance companies, sovereign wealth funds, and institutional investors around the world. The conclusion was, we desperately need better risk management. 2008 had exposed how badly most institutions understood their own exposure. Portfolios that were supposed to be diversified turned out to be correlated in ways nobody had modeled. Products rated AAA turned out to be worth pennies. And the shock was not just the losses, but also how completely the existing systems had failed to see them coming. And here was BlackRock, which had not just survived the crisis, but had been called in by the government to help clean it up, which had a tool, battle-tested, sophisticated, processing thousands of scenarios that did exactly what everyone suddenly realized they needed. So they came. Pension funds, insurance companies, banks, rival asset managers, sovereign wealth funds, central banks. By the mid-2010s, Aladdin was processing the risk for institutions spanning multiple continents and dozens of countries. Today, the platform monitors more than $21 trillion in assets. Not assets BlackRock manages, but assets managed by its clients, run through Aladdin's models. And that number, 21 trillion, that is larger than the GDP of the United States. And here is where the story kind of changes character. Because when 200 institutions all run their portfolios through the exact same risk model, something subtle yet quite significant happens to the market itself. They start to see the risk the same way, which means that they respond to risk the same way. Which means when Aladdin flags something as dangerous, 200 institutions are receiving the exact same signal at roughly the same time from the same analytical framework, making roughly the exact same decision. The market has a mechanism for handling different investors having different views. It's called price discovery. When some people think an asset is risky, but others don't, they trade against each other. The price lands somewhere that reflects genuine disagreement. That disagreement is what makes markets function. But what happens when that disagreement disappears? What happens when that delicate push and pull movement is replaced by a consolidated pull or push movement? What happens when the risky and not risky signals are coming from a single source and they're shared by everyone? You get something that looks a lot like a herd, a very well-informed, extremely well-intentioned, algorithmically synchronized herd, all walking in the same direction at the same time. the UK's Financial Conduct Authority published a quiet but scary warning. It said that the failure of a large portfolio and risk system, it named Aladdin specifically, could cause serious consumer harm or damage market integrity. In the United States, the Financial Stability Oversight Council, the body that was created after 2008 specifically to watch for systematic financial risks, raised concerns that the financial firms may rely too heavily on the same outside risk models. A former Aladdin client put it much more bluntly in an interview. If Aladdin fails, everyone tumbles. Aladdin was built in response to 2008. Its entire purpose was meant to prevent that kind of catastrophe, that kind of system-wide failure that comes when too many people are exposed to the same risk that they don't understand. It was the answer to the question, how do we stop this from ever happening again? And unfortunately, the answer worked so well and attracted so much trust that the system built to prevent concentration has become the largest concentration of financial risk modeling in human history. This is not irony, at least not in the cheap sense, because this feels more like a structural trap, one that doesn't require bad actors or malicious intent to spring. It requires only that a good tool works, that rational actors choose the best available tool, and that the aggregation of individually rational choices produces a collectively irrational outcome. There's a term in ecology for what happens when a single crop variety dominates agriculture. It's known as a monoculture. Monocultures are efficient. They're optimized. They produce consistently excellent yields right up until a single pathogen finds them. And then they fail everywhere, simultaneously, because nothing in the system has a different immune response. Aladdin is a financial monoculture by definition. And it's not because it's wrong, but rather because it's right. Because it's the best tool available, and because its widespread adoption has quietly eliminated the diversity of risk perception that a functioning market depends on. In 2020, during the COVID-19 market crash, the Federal Reserve once again turned to BlackRock. This time, the Feds hired BlackRock to help purchase corporate bonds as part of its emergency market stabilization program, buying assets in markets where BlackRock itself had clients and positions. The conflict of interest was noted by critics, and it was actually acknowledged by the Feds, who basically said, don't worry about it, we have controls put in place. In 2023, BlackRock launched Aladdin Copilot, a generative AI layer built on top of the existing platform, which allows users to ask the system questions in natural language. Now, you don't just receive the algorithm's output, you can have a whole conversation with it. You can ask it why it thinks something is risky. You can ask it what it would recommend. Aladdin was now combined with LLM technology, which, as you all know, is really accurate and really trustworthy. By 2025, Aladdin Copilot was being piloted with central banks and institutional clients as a decision support tool, which means that the system is no longer purely calculating risk. It is beginning to explain its reasoning in real time to people making decisions. And those explanations are shaping what decisions actually end up getting made. This is a private proprietary algorithm that cannot be fully audited by regulators. It was built by a company with financial interests in the outcomes it analyzes, advising central banks, pension funds, and sovereign wealth funds in real time using a generative AI layer that nobody outside BlackRock entirely understands. And the people relying on it, they trust this because it has earned that trust. Because it has been right enough times that questioning this feels like you're choosing to be less informed. Nobody elected the system. Nobody set its mandate. And the most important part is, nobody can vote Aladdin out.